Nick, the most exciting, I think, and satisfying part of my job is that fleeting moment when the wire hits, right? These guys work their entire lives. They're not able to buy Christmas presents for their kids. They face bankruptcy. They've just been through the ringer. Then they do a deal, right? Now it's time that you're working for months. There's tons of stress. You're fighting. It just, transactions can be nightmares. And oftentimes they are. But then when all the work's done, you set the closing call. And the closing call nowadays, it's not like 1995 where we used to get around the table and sign paperwork.
Right.
Now it's all digital, it's all electronic. You schedule the closing meeting, the documents get signed, we exchange signature pages digitally, and then the buyer authorizes the wire transfer. And oftentimes, I'm sitting with my clients when this happens. Sometimes they fly to Puerto Rico, sometimes I'm out on the scene. But when that wire hits and they go from total stress cases to having $75 million in cash in their bank account, a lot of these guys will just break down in tears. I mean, over the years, more times than not, I've seen grown men visibly shaking and sobbing to finally get here. Finally.
It's incredible.
Turn it into something that's tangible that they can go out and spend.
A delayed gratification.
Yes, in its purest form. And so for me, that's a super gratifying and exciting aspect of what I do, to literally hug these guys and say, congratulations, you've made it. Now,
and you've seen them on the journey through those times.
Dude, I've seen it where they don't think the deal's gonna happen all the way up until the 11th hour, and then it happens and they get the money. And I often have discussions myself with these guys prior to this taking place, because I've seen a lot of guys over the years get this money and just do crazy shit with it, right? Like,
I have to.
Relatives come out of the woodwork. Everyone's got a great idea. You're getting calls from wealth managers, and everyone wants a piece of the action, right?
I call it the social tax.
The social tax. There you go. That's a good term for it.
Yeah.
But I often tell guys, like, look, from my perspective, that wire comes in. The most important thing that you can do right off the bat, I think, is reward yourself. Some guys like cars. So you've been eyeing that car for a long time. And more times than not, at least in the types of businesses that we cover, these guys are into cars.
Yeah.
And so they will buy the car.
Has to be an EV though, a green car.
Never happened. Never seen it.
I'm gonna go out and get a Nissan Leaf.
Yes. But they'll buy the car, they'll buy, some guys are into watches, so anyway, I always say it's important, buy yourself that gift. You should have a closing gift, something that commemorates the moment, something that you really wanted, but you didn't want to spend the money on it before. You got the money, do it.
Yeah.
But don't go out and dump $25 million into Bitcoin. Don't go out and start lending money to everyone. I always say it's really important to take 6 months, put that capital into very, very low risk instruments, whatever those may be, and then travel and, buy yourself that gift, and then separate yourself from the business. Because what I've seen is there's always an extreme metamorphosis in the first 1 to 12 months post-transaction.
Yeah.
People leave a deal and they think, well, I'm going to start a different business. Or I'm going to do absolutely nothing at all. And the ones that say I'm going to do absolutely nothing at all, 6 months from now, they're bored out of their mind. The ones that quickly took, it's like, if you've got $1 million in your bank account on Monday, and on Tuesday you've got 90 million, it is really easy to blow 5 here, 10 there, 15 there. Next thing you know, they're in all sorts of things, and it's all ill thought. So when you're dealing with clients, how might is your perspective any different than that? Or how do you deal with that?
No, I think we share that perspective, in that I do think, as we've talked about, it's an extremely emotional transition. And so I advise folks, and what we do with our client partners, is to be like Buffett, Warren Buffett. I'm a huge Buffett fan, but what does Warren Buffett do with Berkshire Hathaway's, I think it's around $180 billion cash hoard right now? He puts it in short-term
in Bitcoin.
UST bill. Oh, Bitcoin, yeah.
No, he doesn't have it. Okay.
Jimmy Buffett.
I think
Buffett.
Charlie Munger, Warren Buffett's, Charlie Munger, Warren Buffett's longtime partner, used to refer as Bitcoin as rat poison. Something I guess familiar with this industry. But what Warren Buffett does is he puts it in short-term instruments. So it's really critical before the wire hits to have the brokerage account open and ready to accept the wire, so that money can be deployed in short-term US T-bills, okay? Which really on a short-term basis are the safest financial instrument or safest investment in the world. As long as the US has the strongest military in the world and the ability to print our own currency, T-bills are the safest instrument, okay? Short-term. And so that's what we do with our client partners, is just ladder T-bill maturities over the next 6 to 12 months. And again, have the folks take a break, take a vacation, go really slowly, and then start to enact some institutional discipline about how that capital is going to be invested over time. And there's no rush. Sitting in cash after a transition like that is perfectly acceptable.
Before you get into other topics, let's go into what like a fixed income ladder would look like.
Okay. Yeah, happy to do that. Yeah. So what that entails, a fixed income ladder, it's referred to as a ladder because you have a bond maturing each month. So that's the proverbial ladder. Okay. So you may have, let's say you have $120 million in proceeds. You'll buy a $10 million bond that matures a month from now. You'll buy a subsequent $10 million bond that matures the month after that, and so on and so forth over 12 months. Then, as these bonds come up for maturity, you can do one of two things. One, you can buy the bond that matures in 12 months from then, right, after 1 month has passed, or you can use that as a systematic opportunity to deploy the capital.
Pull that capital out of the ladder.
Into other investments, right? So at that point, what we do is we can either do it systematically and or opportunistically. So for instance, the bond matures and then you say, okay, based on our investment policy statement and a certain asset allocation, we're going to invest X percentage in stocks, X percentage in international stocks, X percentage in longer term bonds, X percentage in other diversifying assets. Maybe that's a private fund, maybe it's commodities, et cetera, et cetera. And so that way, you're being very systematized of how you're deploying the capital and not just plopping it in day one to, let me put it in 60-40 on day one. And trust me, it's going to go great.
So if I were to exit, we're here in March of 2024. If I were to exit today and $50 million goes into my brokerage account, day one, you're telling me, Paul, we're going to immediately put this into a ladder. Is that what you would do?
That's what I would do. Yeah. And it might be a 6-month ladder. It might be a 12-month ladder. And it really all depends on the shape of the yield curve. And what I mean by that is what interest rate we're able to earn based on how long in the future that bond matures, right? So if we find that a 6-month maturity or 0 to 6 months maturities are particularly attractive or offer a high yield relative to something longer, let's say 12 months, then we might have a 6-month ladder.
I would imagine most of your clients are on the short end of the curve right now.
Yeah, absolutely. Yeah. I mean, up to, let's say 6 to 8 months where you have, advantageous yields of anywhere from 5 to 5.3, 5.4% in those situations.
Okay, so I would be in probably a short-term ladder now, which as a matter of fact, I am. The majority of my liquid investment capital is actually in a short-term ladder. And then what would be the process over the next, let's say 1 to 12 months? So it's all in a ladder. You're like, Paul, go out and buy your watch, just relax. Then what happens from there?
So what happens from there is I think that before any further investments are made, we need to take a step back and really think about that person's personal situation, right? Like, so $50 million, $100 million, these are large amounts of money and are going to be able to fund someone's lifestyle as well as their children, grandchildren, and probably grandchildren's grandchildren, as long as tax planning is done appropriately through estate planning and people aren't spending out of control, which, by the way, wealth doesn't typically last more than 2 generations, right? Like by the 3rd generation, a lot of that wealth has been spent or wasted or lost on, poor investments and high spending. So, but understanding that person's lifestyle before any asset allocation or further investments are made, or their goals and objectives in terms of, let's say you have a pest control business owner or any home service business owner who's really comfortable operating a density-based, route-based business model. Maybe that person wants 5 or 10% of that capital to start an adjacent business. Maybe they were in pest and now they want to start a porta potty business, for instance. And so we also want to allocate a portion of their capital to that and take that into consideration in the existing plan. Who knows? Maybe they have a nephew that's an investment genius and they want to allocate some capital to that person.
Yep.
I think 1% should probably be enough for that, right? We don't want to go crazy here. But from there, I really like to then rely on our core foundational philosophy and how we treat asset allocation, match that with their personal situation, goals and objectives, to then design a thoughtful asset allocation that on a systematic basis, we can start to use those T-bill maturities and then invest in a broader asset allocation. And this is going to be across assets and across the world, okay?
Let me ask you this. Let's say I come to you and I say, Nick, I want to make $1 million a year after tax without touching my principal. Like, I'm in my mid 40s. I'm hoping I live for the next 30 years. So the next 30 years, I want to make $1 million a year after tax. And I don't want to dip into my principal. What sort of analysis would you do for me?
So I think that's
is that not the right question?
Yeah, no.
I mean, I don't know if people ask you that.
It's actually
because I've heard it.
Oh, it's a common question.
Okay.
Right. And for some reason, these shiny round numbers come up where it's like, I want $1 million, or I want to sell you probably heard this one. I want to sell my business for $100 million.
Yeah, 100 all the time. That's the magic number.
I hear all
100 million is the old. It's the new 10 million.
It is. I think you're right. I think you're right about that. I would agree. And so I think it's a great question that people ask, because I think it also highlights something that's very unknown amongst the entrepreneur community, and it speaks to what's a normal return, or like what return can I expect to get, because people don't know, and that's it's something we help them with through this kind of cash flow forecasting and planning exercise, because they think about it and they're like, okay, if I sell my business for X million and my returns are Y%, but then like the analysis, like it's like the record skips at that point. Well, what is a normal return? Am I going to earn 2%? Am I going to earn 15%, or somewhere in between? And so we help them think about that. And I'm like you, like we're history investment nerds ultimately.
Yep.
And so we've studied historical returns over time, the volatility of those returns. So we can speak on that topic, obviously. And when I look at those numbers in a responsible, risk-controlled, diversified portfolio, I think that we can earn a return that's somewhere to 4 to 5% above what cash earns. Okay, and cash over time, over the last 100 years, has earned about 4.5%. Right, so we're talking about a high single-digit return. But in terms of your question, and what can they how much money do they need to get $1 million after tax? I like to pare expectations back a bit and not set them too high. And so if someone has, let's say, $16 to $20 million after tax, right? So that's the after tax portion of their sale, they can expect about $1 million after tax in terms of returns. And that's really thinking about it at around 6% after tax returns, like 5 to 6%, which again, I think is conservative, and I'm confident we'll easily beat that. But I think it's a reasonable expectation.
Because for me, I find that a lot of our clients look at that sale decision in the same way that a lot of families look at, can I afford a house? They don't look and say, that house is $1 million. They say, what's that house payment, right?
Exactly.
And so in the same way, they think like, okay, I want to be able to spend $500,000 a year. Like I want to be able to buy cars and travel and all sorts of stuff. So, and then that takes care of my food, and I can cover my nut with $500,000 a year.
Yeah.
So what do I need to have? And to know I can do that in perpetuity, like until I die, and then whoever, like my heirs will take whatever. But if I can do 500 grand a year, I don't need any more. So it's always like reverse engineering, what do I need to sell for today, given the current tax environment, in order to be able to do that? That's always the calculus, it seems to me. And people ask me that. They're like, Paul, if I need to make $1 million a year, what do I need to sell for today? I'm like, okay, well, that's not my bailiwick. I can tell you what you can sell for today, but that's not what I do. But do you feel like that, with the entrepreneurs you deal with, is that a pretty common way they look at it?
It is a common way they look at it. And I actually think it's sensible in a lot of ways, right? Because it's their shorthand of doing a cash flow forecast. Like, I like to get into the details for them, because then I think if they know how much they need and they know what you've told them that they're likely to sell for, then they can go into that transaction with confidence, right? Instead of this nebulous idea in their mind, it's actually quantified. Well,
because like for them, thinking about it from a percentage, X% return on a risk-adjusted basis doesn't really mean anything.
No.
It's like, okay, how much am I going to get every month? What am I going to be able to spend? What am I going to be able to tell my wife she can spend?
Yeah,
right.
Exactly.
They need to know that.
I mean, and the problem is that I think really marrying that expectation and that outcome that they want in terms of the after-tax dollars with an investment strategy, because I think most folks would be unaware or surprised by the statistic that 3 out of the last 9 decades, so 33% of the decades, stocks have produced a negative return versus cash. Okay, like when I first ran this data, that was a surprising statistic for me as someone that's been in the investment industry for 20 plus years. Okay, so if you have this expectation that you're going to use 100% stock portfolio or 80% stock portfolio, specifically US only, and you want to get $1 million and then you put it into the stock market and earn no money for 10 years, you're not going to feel great, right? You're like, why in the world did I sell my business in the first place, right? And so that's why it's critical for us to actually design a portfolio that's thoughtfully balanced across diversifying assets, not just stocks, not just bonds. I mean, you and I have been over this plenty of times, but balance is not 50% stocks and 50% bonds or some derivation of that, because frankly, those two asset classes are often correlated. So that's like our job though, to make sure, and we take that responsibility critically seriously to make sure our client partners don't go 10 years and make no money, right?
Well, how involved do you get in, if I think about my own portfolio, so I am not your standard guy because I actually do enjoy actively managing my own portfolio, and a lot of times to my own detriment, by the way. But I also, outside of equities and bonds and so on and so forth, I like to invest in emerging market real estate, for example, right? And so how involved do you get? If it was somebody like me who says, hey, Nick, I've got X amount here in these equities, I'm in some hedge funds here, I've got a credit fund here. Oh, and by the way, I want to deploy some capital in Djibouti or Uzbekistan. And I'm looking at
that's a very common question.
Right, I'm sure you get that all the time.
I got that yesterday from a guy in Tennessee.
Yes. So, but I'm looking at, I was just in Turkey last week and I'm doing some investments there. And so that's not something that you obviously actively manage. You're not managing emerging market real estate portfolios in Turkey. But I mean, how involved would you get with me in sizing up how that particular investment fits in the risk parameters in my total portfolio, as well as helping me look at it and say, Paul, I don't like the cash on cash returns of that based on what I see. I mean, how active do you get in that? I know it's not a common question. No, I'm just curious.
Paul, I say this with all humility.
I'm going to outsource some financial analysis to you.
I say this with all humility, but you actually came to the right place.
Yeah, okay.
Right? Like, I'm not for everybody, but I did invest globally in public equity and public credit assets for almost 20 years. Okay, so actually, I could probably help you with those real estate investments in Uzbekistan or Kazakhstan or wherever the case may be. But look, we take a different approach. So I think the structural advantage of being a late mover into this industry, let's say versus Morgan Stanley or someone like that, and also being a privately run business that's run for the benefit of our client partners, is that we have very strict compliance standards, but within those compliance standards, we can make decisions about how we help people, whereas bigger firms cannot, right? And the point that you ask, or the question that you ask, really touches on this, in that if you were to ask somebody at a big bulge bracket firm, can you help me with this real estate in Cambodia, for instance, just to throw out another one, they would say, oh, no, our compliance will only let us look at these investments that we select for you, which, by the way, the firm's probably getting another kickback for selling you those, right? So since I have 20 plus years of experience, value, and assets around the globe, we can have a nuanced conversation about that. I'm sure you've modeled them out or had someone on your team do so. We can go through the specific variables within that model to provide more input, and also a sounding board to help you arrive at a sound decision collectively. Okay, and that's something we do for pest control owners in their own business. So they want to buy a piece of real estate that they're going to use in the business. So instead of saying, no, don't do that because that's going to take money from me.
That was going to be my question, because clients over the years that these guys use all sorts of wealth advisors and financial advisors and so on and so forth, and inevitably, and as you well know, our clients tend to be, they've got their business and they've got their real estate, and then they've got some hokey business that they shouldn't be involved in at all, but they're involved in it.
Yeah.
They got the porn studio out in the mountains somewhere. Like, they just doing all sorts of stuff. And so a lot of times the financial advisors will discourage them from doing the things that they want to do, not because it's a bad investment decision, but because it's out of their purview. Exactly. They don't get a fee on it. Maybe they don't quite understand it. So it's inevitably, why don't do that? And why don't we put you in some, GM stock or what have you? I don't know. And so my question then was more precisely to what effect can I expect a guy like you to say, Paul, I'm going to help you on all of your financial endeavors. I am going to look at your core business to the extent that you want me to. You want to go to Cambodia and look at real estate? I might not be a Cambodian real estate expert, but I'm going to do my best to help you model this out and determine whether or not that fits within the risk parameters of your portfolio. And if it does, I'll have at it. As opposed to being, I'm not suggesting that you would be self-serving, but it is something that's prolific in wealth management, as you know. It's like, if we don't do it, it's not a good idea.
So I am self-serving, okay? But what I'm self-serving about is compounding. So there's compounding, the compounding effect of an investment and how that builds and builds, and effectively compounding is earning money on your money, okay? I think that same concept applies to relationships, right? You have this compounding value in relationships, in how you interact with people, in the value you provide for people. And I think this question that you're asking touches on that, because if I'm able to provide more and more value and be a critical resource for any of my client partners, even if they're taking money out of my purview to invest it in something else, and I'm helping enable that, reduce friction, and also help them arrive at a better decision, that's just compounding the value of our relationship, with over time is going to be best for my client partner. And guess what? It's going to be best for me too. So in that way, I'm very much a greedy capitalist, because that compounding relationship, I think, just pays dividends for everyone down the road.
Awesome. Well, thanks for sitting down with me today.
Yeah, absolutely. I appreciate the questions. As always, it's great to spend time with you.